Let's talk about the regionals. Regional bank shares rallying as traders count down to the Fed's rate decision. Small and mid-sized lenders poised to see much-needed relief, with borrowing costs expected to fall for the first time in 4 years. Joining us now, Herman Chan of Bloomberg Intelligence. Herman, welcome to the program.
Thank you. Thank you.
Why do rate cuts help? Let's start there. Why is that an important channel to alleviate some of the pain these lenders have been going through?
In our view, there's three main reasons why the market's really enthusiastic about rate cuts and the banks as well. Number one, as you mentioned before, deposit costs will come down, and deposit costs, as you can recall, have been a hindrance for banks with their net interest margins over the past year or so after the SVB failure. Number two, we could see potentially better credit quality, lower borrowing costs for their customers, so it could help lower the net charge-offs for the banks. And number three, we haven't seen a lot of loan growth given elevated interest rates. So lower rates could potentially spur some improved demand on that front.
The word I'm interested in here is relief. Is this just a relief rally? And we've seen the regional banks on the KBW Bank Index up by something like 15% so far this quarter. We've seen the relief rally. Do you see a sustainable tailwind into 2025?
I would agree that it's a relief rally, but you have to step back. We're really just back to the levels of March of 2023 before SVB failed. So we're just back to where we started. I would also say that the banks are talking about improvement in net interest income for 2025. So there's still some potential tailwinds from repricing of fixed rate assets, and the margin could stabilize with lower deposit costs. So that's all helpful for banks going forward.
So are high rates good for them, or are low rates good for them?
Stability is good for them. So the expectation is we have a rate cycle that's more predictable versus what we had last time. So that's what banks would like to see: stability, a positive sloping yield curve, and potential for loan growth to return. So that would be the Goldilocks scenario.
There's a real question about whether we understand the impulse that lower rates will have through some of the markets that have been the most stagnant. And I'm thinking of commercial real estate. I'm thinking of real estate more generally, just anything having to do with property. And these banks are highly exposed to valuations that maybe haven't been fully reset because there has been no activity. So at what point could you see ongoing resetting in prices that could be harmful to their bottom lines going forward with lower rates? Yeah,
that is a risk, and that's something that the banking industry will still have to work through. I would point to the fact that the PNC CEO recently noted at an investor conference that we're still really only in the first inning of a shakeout in the office commercial real estate market. So there's still going to be more to come.
So help us understand which part of the regionals we want to play then. Seemingly it's going to lift all boats. Is it fair to say it lifts all boats?
It will really depend. You have to dig deep into where the interest rate positioning is for the balance sheets. But overall, banks have hedged a lot of the potential downsides for lowest interest rates. But it will be from bank to bank.
This will sound somewhat snarky then. We need to identify the banks that really mismanaged their interest rate risk when rates were rising. And they're the ones that benefit the most.
Exactly. So banks, you could point to banks like Comerica and KeyCorp in the larger regional space that could pick up that tangible book value that they lost during the rising rate environment.
I love that, John. I don't mean to sound snarky, but...
Well, no, I think it raises an important question. Relief rally or long-term bet? Are these management teams that I actually want to put money behind for the long term, given how badly they mismanagement interest rate risk on the way up?
Right. So you can say that there's some unlocking of the laggards during the past year will now be the beneficiaries of lower interest rates.
So at this point, what is the right time to get into regional banks? I mean, how much are you advising people? I know you're not going to recommend buy, sell, hold, whatever, but how much do you see people interested now versus, say, 2 months ago, and now people say the trade is up?
Yeah, I think there's still some optimism that we're really over the hump. So over the past couple quarters or so, there was still some potential for margins to really stagnate, but the banks are over that cliff, and we're actually at the we've hit the bottom of margins, and now there's potential for that to continue to upward slope in 2025. So there's some positive sentiment out there, but there's, on the other hand, there's still unknowns on where the economy is going. Is it going to be a soft landing, or are we actually going to hit a recession? So I would point to that as well. So there's going to be some puts or takes.
Herman, thank you, sir. Herman Chan of Bloomberg Intelligence on the latest with the regionals, going into an important Federal Reserve decision later on this afternoon.